Today, we're going to decode the complex and honestly kind of contradictory optics of GMM Pfaudler. Are we looking at a hidden contrarian gem here? Let's get right into it. Welcome to Stress-Free Investing Analysis Personal Notes. Just take a quick look at the disclaimer on your screen. Keep in mind, this explainer is purely an educational deep dive into the data. To make sense of all this, we're going to systematically peel back the layers. We'll start with their position as a global leader. Untangle the profit versus cash illusion. Look at the risks and red flags. Check out their record backlog. And finally, map out the valuation. Section 1. The global glass-lined leader and a near monopoly in critical industrial equipment. So let's start by understanding how an excellent standalone Indian company basically bought out its own parent to become a worldwide powerhouse. Back in 2021, GMM Pfaudler pulled off this bold reverse acquisition of the global Pfaudler Group. Overnight, they went from being just an Indian leader to an absolute global titan, grabbing a massive 50% market share in the Americas and India and 40% in Europe. Now, looking at how their revenue breaks down, while their core glass line technologies drive the bulk of it at 61%, you've really got to notice that 24% services segment. This is absolutely crucial. Why? Because it brings in highly profitable recurring income. We're talking aftermarket services, maintenance contracts, and spare parts, all yielding sweet 18 to 20% EBITDA margins. And this brilliantly illustrates exactly why their business model is just so resilient. They've built an incredible wide moat. We're talking proprietary glass-to-steel fusion formulations they've perfected over 60 years, 19 manufacturing sites globally, stringent regulatory certifications that take competitors literally years to get. But you know what the real magic is? The switching costs. Once their glass-lined equipment is installed in a pharma or chemical plant, they're essentially irreplaceable for the 15 to 30-year lifespan of that plant. Replacing them would mean millions in redesigns and years of waiting for reapprovals. It's a total lock-in. Section 2. The profit versus cash illusion, or decoding the financial paradox. This brings us to the core mystery of our whole analysis, the dramatic, kind of crazy disconnect between their reported profits and their actual cash. If you only look at the ugly optics of their reported earnings, you'd probably run away. A tiny 2% profit after tax margin and a PE ratio around 70x, that looks terrible. But hold on. Look at the beautiful reality underneath that. They are actually generating a massive 318 crore rupees in free cash flow. That's a stunning 7.9% yield. Their operating cash flow is almost 8 times their reported profit. So you're probably wondering, how on earth can a company look so painfully expensive on earnings, yet so unbelievably cheap on cash flow? Well, this paradox is explained by what we call the integration trough. See, after taking on 633 crore rupees in debt to acquire their global parent, they got hit with massive non-cash depreciation and interest expenses. This created a huge accounting drag. It basically crushed their bottom line on paper without actually draining the real cash. So they report just 49 crores in PAT, but generate 318 crores in free cash. They are quite literally swimming in operating cash, while their P&L statement just takes a temporary optical beating from the acquisition integration. It's a classic illusion. Moving on to Section 3, risks, debt, and red flags. Let's evaluate the real vulnerabilities here. To keep this analysis totally objective, we have to talk about the genuine structural overhangs pressuring the stock right now. The single biggest governance red flag? The progressive exit of their German private equity promoter, DBAG. Over the years, the overall promoter holding has dropped down to a pretty low 25.18%. Now, while the founding Patel family hasn't sold their core stake, the optics of this private equity exit, even with a high-quality name like ChrysCapital stepping in, well, it's definitely left a bit of a cloud over the stock's sentiment. So the crucial thing here is balancing these risks against reality. Yes, total debt is sitting at 850 crores and interest coverage is at 3.5x, which is, slightly below our ideal comfort zone. Plus, their German operations have been struggling, which forced a 43.6 crore rupee restructuring hit to cut the workforce there. But listen, these are manageable watches, not catastrophic business failures. Their immense free cash flow comfortably services that debt, and the German restructuring, it's a necessary surgical move to stop the bleeding and get things back on track. Section 4. Record backlog and catalysts. These are the indicators of a turnaround. Now that we know the risks, let's look at the really powerful leading indicators signaling that a major recovery is already happening. 2,205 crore rupees. That massive number represents their all-time record order backlog as of Q3 FY26. Just think about that. It practically guarantees 9 full months of revenue visibility for the upcoming year. The demand for their equipment isn't just stable, it is actively accelerating. Furthermore, they've brilliantly diversified. Half of their new orders are moving away from traditional cyclical chemical markets and going straight into high-growth sectors like defense, nuclear, and oil and gas. Back home, the standalone India operations are absolutely crushing it, with a 52% year-over-year jump in their 9-month PAT. Add in a major €33.2 million contract win for Normag in Europe and over 40 crores in expected annual savings from that German restructuring by FY27. I mean, the turnaround engines are clearly firing on all cylinders. And validating this whole turnaround thesis is the steady accumulation by domestic institutional investors. Just look at this growth. From 10.58% in early 2023 up to 16.30% by December 2025. This is a huge signal. The smart money, Indian mutual funds, are quietly building conviction and accumulating shares at these lower prices, even while retail investors might be getting a bit shaken out. Which brings us to Section 5, Valuation and Investment Verdict. Let's price this recovery. Finally, let's translate all these operational metrics, cash flows, and catalysts into some actionable valuation scenarios. In our base case scenario, a target of 1,200 rupees offers a solid 34% upside. And what's really incredible here is that this base case relies solely on a very achievable EBITDA margin recovery to just 14%. We're not even banking on the 16 to 18% management target required for the bull scenario. When you map the risk-reward against the enterprise value to EBITDA multiples, it looks exceptionally compelling for a global leader. Now, if we do a reverse DCF analysis, which basically tells us what expectations are currently baked into the stock price, it reveals something fascinating. The market is pricing in almost zero growth from current cash levels, just a 9.6% free cash flow CAGR for the next 7 years. This is way below the company's backlog momentum, way below historical norms, and way below analyst expectations. Essentially, the market is priced in the absolute worst-case scenario, which gives us a fantastic margin of safety. So ultimately, the verdict here is to accumulate on dips. This is a rare opportunity to grab shares of a dominant global monopoly at a steep discount. You can literally let that incredible 7.9% free cash flow yield pay you while you wait for the integration margins to normalize over the next 18 to 24 months. So the ultimate question remains, will GMM Pfaudler's massive cash generation finally break through these optical illusions, or is the market right to be this pessimistic? Time will tell. Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next video. Thank you for watching, and keep your investing stress-free investing.